I have the pleasure today to be joined by two experts who have a vast amount of experience both in supporting companies by funding them as well as in growing those companies. So as Tristan mentioned, I run communications for Hedera Hashgraph. We are a next generation distributed ledger. There are tons of different ways that companies are raising capital, deploying capital, using that for their growth these days. So I would like to start off introducing Toby Russell with Shift. And Toby, I'll let you give the audience just a few minutes on your background.
Hey, thanks, Zenobia. My name's Toby Russell. I'm the co-CEO of Shift.com. We sell cars online, bringing e-commerce to a large space. And in my history, I've founded a bunch of companies, worked in government, large companies, small. And so excited to share about that journey here today.
Great. Thank you, Toby. And we also have Anis Uzzaman here from Pegasus Tech Ventures.
Hello, everyone. This is Anis Uzzaman, and I am actually general partner and founder at Pegasus Tech Ventures. We are a global venture capital firm. We've invested in more than 200 companies, managing about $1.7 billion right now, and looking forward to the session today. Thank you.
All right, great, guys. We're going to jump right into it because I know we have a short amount of time today. Anis, you've done hundreds of investments in companies over the years. Out of those, are there any that stood out to you as, gosh, right away, I was like, I must invest in this? And do you see any patterns there? And then I'll also ask, are there any that at first you were not sure what they would look like, but somehow they have evolved and they have certain characteristics that really made them home runs?
Good questions. Thank you very much again, Genevieve, for having me at the session. So one of the companies that right away when I saw it, I said, like, yeah, this is a great investment, and it is turning out to be a great investment, is a company called SpaceX. I think you all know about it. I have already invested in this company multiple times. So SpaceX is a company that everybody thinks it's just a rocket launching company, space exploration company. But when I looked at this company deeply as I became an investor, this is not only a rocket launch company, but they also started putting together a new internet infrastructure known as Starlink. They're in the process of launching 12,000 satellites to the lower Earth orbit so that we can use the next generation satellite-based broadband internet. And this is becoming a very big thing. They have launched beta testing in more than 15 countries around the globe. They're also, getting all the NASA contracts to go back to the moon and Mars. They're even thinking of putting together a colony in Mars in late 2000s. So this is a great company. They're growing rapidly, and because of the current situation globally, I'm seeing that they're making much more progress. And so this was a home run from get-go when I got the opportunity to be able to invest. Another company I will talk about where I was not sure that it will be a great home run, but as I started working with them, that company turned out to be really successful. This is a company called Affectiva. They're based in MIT. It's an MIT spin-out. It's started by an Egyptian female founder. Her name is Rana Kaliobi. And when I first met the company, I was not sure. They do emotion detection, AI development in some sense. I was not sure at the beginning. She was not the CEO. She was just the founder, but then she took over and the company started moving towards the right direction. And guess what, earlier this year they got bought out by a Swedish public company called Smart Eye. So that was a company that I was not sure at the beginning, but when the founder became the CEO, things started changing and it made us all happy in some sense.
Great, thank you. And Toby, on the flip side, nowadays there is more and more capital, it seems like, competing for deals. So for you as an entrepreneur, as you look at where do I raise that capital from? Do I go to traditional VCs? Do I, to angels, everything from that to PE firms that are coming downstream and investing more like what venture firms have traditionally done? How do you decide who's going to be the best investor for your company at any particular time?
I think it's a great question, Zenobia, and I think it is really important to think about what stage you are at in your company in order to choose folks who are aligned with the stage you're at. And then think about, what does your next stage look like? And will the folks that are investing at this stage be able to either participate in that next stage or help you develop out the right connections with the folks that would be in the next stage? Example, seed funding is really appropriate when you're like, hey, I want to do exploration and we just got to figure it out. Maybe start putting together ideas and a team. If you're thinking about like, hey, I've got a team and we've got the right idea, but really it's not fully built out, but we've got a lot of momentum here. You start thinking about a Series A way down the pike. You got to think about if you're a capital intensive business, are you able to make your way into like sourcing public financing or elsewhere? So really it's about the stage you're at. And then within that, I do really coach saying, hey, get to know your potential investors and understand whether you guys are aligned on the goals of the company. Because many investors and a lot of companies are like, hey, we want to find an exit quick. Makes sense. Others are like, no, we're more interested in creating runway and exploration, building a lasting company. We're gonna take our time and invest and get that thing right. Just making sure you're in sync on that is really pretty critical. Because if you're out of sync with the phase or the goals with your investors, it's going to cause a lot of headache for everybody.
Thanks, Toby. I think that's a great framework for people to think about. Enes, you have talked a little bit, early on about investments in different geographies. You guys are global. You've invested all over the world. How do you think about those companies differently if, for example, they are a startup based in Silicon Valley versus, somewhere else in the US, or quite frankly, if they're in a different geography? How do you think about those entrepreneurs? Maybe, a framework for how you think about investing in those companies, and what are some of the differences that you've seen?
Good question, Zenobia. So we invest both in the US and outside of the US. Literally, we invested about 100 startups in the US and another 100 startups outside of the US.
Wow.
So, in different geographies, we have to take a different strategy because the startups are different. They are different in characteristics, how they operate and how they work. For example, we have a big presence in Japan. So when we are looking at the Japanese startups, we tend to be valuable to them if they are planning to globalize in some sense. So many of the Japanese startups who are trying to go global, they want to come to the US, they want to be going to the Europe, then we become very valuable. So we are working with a lot of startups in Japan who already have done pretty well within the country, and they're ready to take the next step to go global. And that Japan, historically have a lot of brands like Sony to Toshiba to Fujitsu, a lot of brands that are global brands. So we see a lot of potential in many of the startups who can become global brands, and we're working with them to make that happen. We're also investing in countries like Southeast Asia. We all have a big presence in Indonesia, which is the 4th largest populated country in the world. When you're looking at Indonesia, that area, the Southeast Asia region, that region has about 600 million people. So when you're looking at a company there, we're not looking at more like technology savvy company. We're looking at companies which can expand into that and use that population in their benefit in some sense. So every single region has their own characteristics, and we're trying to adopt and create a strategy around that so that we are successful in each of the regions where we are investing in some sense.
All right, quite a broad swath there. Toby, I want to go back to a point that you were making just a minute ago. You mentioned that some businesses are more capital intensive than others. You've grown companies, you've grown various product lines. Can you talk a little bit about how that differs, both in terms of the capital raising process as well as your use of capital, depending on the vertical that you're going after or the product line that you're rolling out?
Yeah. So the one common theme, having worked in a bunch of different industries, things like financial services and ground transportation, think Uber, Lyft, and over in auto retail and retail, the common theme that I've found is making sure that you're clear on working back from your customer. The industries that I have found that I've entered tend to be built for the industry themselves. Like banks were built for bankers, auto dealerships built for auto retailers, and so taxi companies were very much built for the taxi operators, not the users or even the drivers, dare I say. And so being able to like work back from that customer need is a big one. However, I also have found that in doing funding rounds, even as you're looking to disrupt, you oftentimes can find, institutional capital is great. I personally have had, as I was reflecting on this for the session, surprising success with strategic investment as well, particularly at later, like sort of later stages, starting out with more, call it angels and VC funding at the earlier stages where you're like, hey, we're betting on a team, betting on an idea, betting on a technology. But as you get later into that industry, you oftentimes want to take on a little bit of the institutional advantage while still being a disruptor. And so there is goodness there in putting strategics on your list, not as like the way to build your company. I would be careful about that, but as a source of funding where you might want a little bit of institutional support in the industry you're driving at.
And Toby, just to clarify, by strategics, do you mean, companies in the space who have perhaps a venture fund, if you are in the automotive space, perhaps some of theirs, or are you talking about something else?
Yeah, exactly that. So folks who have a venture fund want to be learning and innovating in the space, but maybe are like a large established player and or are interested in moving into that space, like they're in a slightly adjacent space, but want to expand into and learn that zone. That can be it can play out really well. Example, when building an Uber competitor, worked with a company that did business travel. They're like, hey, that's a vertical we're interested in getting into. We would be interested in funding and supporting that. In doing Shift and auto retail, worked with an original equipment manufacturer, like a car maker that was interested in learning their way around retail. And same thing, like worked with a retailer that was traditional but wanted to explore e-commerce. So there are opportunities when you can find someone where there's a good fit and an adjacency for them, and a lot of growth for you in that industry. So I wouldn't write off strategics entirely.
Genevieve, if I may jump into
Please.
that. Toby, you actually just spoke my mind because what is happening is in Pegasus, we are doing a special VC as a service model. So most of our investors are large corporations. We have actually 35 large corporations who have given us the capital. And the main goal they have is to hook up with startups like Shift, who have, so we have a lot of automotive, for example, LPs or limited partners who have built a VC fund with us, and they want to meet startups like yourself, and they want to have a strategic relationship so that it can be a win-win situation. They share their experience, expertise of expansion, and then you also show them newer ideas, because when you're in a large corporation, it's so difficult to innovate, and corporate innovation has become a very big theme in the market overall, right? Many of the corporations do it by themselves, but we as VC companies are also offering that service to many large corporations nowadays, and that has become very interesting to the whole community itself nowadays.
Great, thank you both. I know before we joined here, we were talking about the latest vehicle that a lot of companies are using to get to the public markets. Anis, I know you mentioned you have a number of companies who have gone public through a SPAC process this year. For both of you, I'd love to just understand where you see that market now versus where it was perhaps 6 or 12 months ago, and some of the lessons learned from taking some of those companies public via a SPAC.
So SPAC, I think, is a blessing to the community. It is good for us investors, it's good for the community. I also think it's good for the country itself, because it does gives liquidity to the whole community in some sense, right? SPAC, I think, is definitely something that will encourage innovation and entrepreneurship, because many of the, during the pandemic, one of the things that we have seen, there's a big pile of companies who were worried that they're not able to raise more money because of the pandemic, because they're uncertain about how their valuation will look like if they go for a regular IPO, pathway in some sense. So SPAC came in, and SPAC gave them the guarantee that when they go out, they exactly know how much their valuation would be, how much the share price is going to look like. So it's the guaranteed, in some sense, you can pre-negotiate the stuff. So that gave the peace of mind to many founders, including, I'm sure that Toby enjoyed that, the security and the peace in mind that, this is how it's going to look like after IPO. So that was a big thing. Plus the other thing I was just, discussing with Toby, that the timeline, right? If you look at regular IPO, I mean, we end up spending a year or two in preparation. I mean, that can be a lot of time spent, and it can defocus you from doing your real thing, that what you're trying to do, right? Versus SPACs, I mean, it can, you are looking at maybe at most 3 to 6 months, in the process as a startup, from the startup's point of view. So in all sense, I think it is a great scheme that I think should be there in place, that actually gives many of the startups the opportunity so that they can raise some capital and can grow to the next level. Great thing for the community. I support it.
So my take on this thing, agree with a lot of the virtues that Anis was describing. I always coach folks that are asking, hey, how do I fund my company? Think about all of these funding methods as a means to an end. As we were growing Shift, people would say, hey, when are we going to IPO? What will we do? And I'm like, an IPO is not an end state. It is not a goal. It is not an intrinsically valuable thing. It is a way to fund the company to achieve the mission that we have. There are a lot of ways to fund the company. We talked about them: seed funding, ABC rounds. There's debt financing. There's strategic investment. There's a variety of mezz financing. There's a direct listing, IPO. There's a SPAC. There's a 144A. There are a lot of different ways that you can go about doing that. And the way we look at it is those are all tools in the toolkit of an operator. Understand that every tool can be used well or poorly, and make sure that the tool you're using is right for the purpose you have. In the case of Shift, we were at a stage where we're in the midst of a global pandemic, wanted to keep capitalizing the company and wanted to de-risk the idea that like markets could drop and go crazy and a direct listing could get disrupted. So we're like, all right, our goal is to focus on growing the company and the mission and capitalizing. So it turned out that at that point in time, a SPAC was a good tool for doing that. Wouldn't say therefore it's good for everybody all the time. Like it's a you got to evaluate where the stage of your company and the capital needs, and you really got to think about, these are just capital needs. That's a means to an end, and the end is build your company, serve your customer, achieve your mission. Like that's really what not to lose sight of.
That's fantastic. I do want to know, and I'm going to ask sort of one wrap-up question here, and then we're going to open it up to the audience for any questions. I believe you should be able to go into the Q&A tab in your session and type in there. And if all is working well, I will be able to see those comments in there. Toby, you mentioned direct listings. That's been something that has gotten a lot of attention recently too. Again, another vehicle, but any pros and cons to that either of you have seen?
Happy to take a stab. I mean, again, it has its virtues, creates a lot of liquidity for existing shareholders and investors. It can capitalize a company, but it doesn't always optimize just for that. So it has a lot of virtue. It also tends to create, just through the nature of a roadshow and the high profile phase of it, it creates a lot of retail investment, a lot of interest in a company, particularly if it's a company that's understandable and accessible to a lot of folks. So there can be, and there definitely is a lot of positivity and goodness there. But that depends on, hey, is my company? You got to look at it like, is my company at the stage where we're trying to achieve those goals? Create liquidity for a lot of existing shareholders, build out a large, oftentimes large retail base. I'm speaking more from like the Silicon Valley tech company or consumer company. I know that's not true in all cases. So, just bear with me on that one. That's the lens. You tend to be consumer facing. And so your retail investment base will go up with a kind of a high profile IPO approach.
From my side, direct listing is a little bit, I think, a little riskier than, the other method. You have to be really confident when you're going for direct listing that, your brand name is well known and it's out there. You're confident that people are going to support you through the whole process. again, I will be very careful, as Toby mentioned multiple times, that you need to pick up your game. You need to know your company well, right? That which one is the best fit for you as you're trying to raise more capital, as you're trying to give liquidity to your existing investors, and also looking for participation from outside world. Again, I personally feel that direct listing is a little bit riskier than a SPAC or a regular IPO. But if you're a good brand and if you're well known, please take the risk and go there and give liquidity to the community.
And Anas, as you guide some of your companies over the next 6 to 12 months, thinking about their capital requirements and and what liquidity looks like, I'm guessing it's probably very different for each and every individual company. But are there any broader market signs that you are sharing with these companies in terms of markets continue to sort of look the way they've been looking, or types of folks that you are you encouraging them to conserve capital, to be aggressive? Anything you can share there?
So, Genevieve, it's a good question. Throughout the pandemic, we actually spent a lot of time working with the founders, and we're trying to make sure that we actually guide them through the process, because in Silicon Valley and overall in the US, I think venture capital investment has to be smart. It's not only money, but the advice and mentorship that you provide to your startups is very, very important. What we have tried to do throughout the whole pandemic, we have tried to advise the startups to raise as much capital as possible. Things had not been that great for many startups because many of the investors became a little bit careful and conservative during the whole pandemic time. But I think, as we told all the startups to conserve as much money as possible so that they can go through the pandemic, and at the end of the pandemic, which is what we are seeing right now, experiencing right now, I mean, they have enough capital so that they can actually survive. So a lot of startups, we are advising them now to actually start putting together a good plan so that they can fundraise, because we are getting out of the pandemic quite a bit now, and this is a good time for them to prepare for the next. I'm advising them to actually put together a big marketing plan, put together a big plan where they can expand in a bigger way. We're not there ready yet 100%, so I am still wanting them to be careful at the same time, but put together a very nice plan that the investors can work with you, and they can trust you, and they can believe in you and take the next step in some sense.
Great, thank you. And Tristan, I think we get you back for the Q&A session.
Yes, you do. And thank you so much. What a fantastic conversation. What you were just talking about, you ended with a discussion about the pandemic and its effect. I was wondering if we could expand just a little bit on that. My question is, there we go. My question is, when the pandemic struck, obviously funding was something that was going to be disrupted by it, but were those challenges different as the pandemic went on, say 6 months to 12 months? Did the challenges change based on what areas were getting the vaccine, what areas weren't? When it comes to funding and trying to take a startup, it's got to be one of the most difficult times to move a startup from one phase to another when the world's in flux. So how did those challenges differ as the vaccine rolled out and things changed in the last year?
I can go first, maybe. So during the pandemic, I think we had to advise the startups to manage and maintain, and we got a lot of requests from them to help them out in the process. So I felt that every single startup faced different types of issues. First of all, how to manage the expectation of your own employees, how to manage the expectation of the investor group who invested in you, right? And how to put together a plan so that you can survive through the pandemic and conserve the money you have so that you do not need to raise during the pandemic, because I think many of the investors became very conservative. So managing your employees was one of the biggest things, because the rules kept changing. All the counties, all the cities were changing with their rules. So the startups had to keep up with that. Can I have the employees in-house or not, right? Should they work from home? Stuff like that. The second one was that the investors like ourselves, we also, talk to the startups, what is going on? I mean, when you're planning to raise your next money, how much money left? I mean, are you, running out of business? Things like that. So they had to also manage the expectation. The development, phases had to be slowed down in some sense. The expectation had to be reset, and many of the founders actually tried to do that. At the same time, so there are a lot of aspects to that, and we helped the startups through the process, guided and mentored them throughout the whole process. And now, as I was mentioning, that we are almost over, and different sectors or different regions are already well vaccinated. So again, need to put together a new plan on how you can start pushing the gas pedal and accelerate your business in some of the regions where business is coming back to normal. So it's a lot of navigating, it's a lot of twisting, but I'm sure that the good founders are being able to do that.
And speaking of the good founders, what's the kind of reverse challenge when you're in charge of the company and not the capital that's investing? Did initially everybody had to kind of hunker down and do what they had to do, but as things changed, did it was it more intense trying to figure out how do we catch back up, or was it more like, okay, now we're back to doing the funding rounds or the growth that we were planning?
So I think I'll take that one, Tristan. It depends a little bit on what kind of company you were in. So I think everybody in that immediate, call it like late March, April timeframe, at least on the West Coast of the United States, was like, whoa, how are we going to make sure we survive? Folks were making tough decisions on, do we lay off workforce? Do we furlough people? How do we handle that? And everybody had to make a lot of hard calls in the context of very little information. It was is this going to be a 2-month thing? Is this going to be a 2-year thing? And we still ultimately don't really know. But at that point, we had no idea. And so the very initial phase, you were saying, each I think company had to say, what kind of runway do we have? And what philosophy are we going to take in terms of our operating in this future, in this near future phase? What do I mean by that? Some companies were like, we're just going to have to shut down. Like, we literally can't do what we do. We're non-essential, and we require in-person working. Can't continue doing what we're doing. Most tech companies, I think, were able to say, no, we're going to move pretty quickly to remote and keep doing what we're doing. And folks relatively then soon thereafter, as we moved into almost a phase 2, realized that for most tech companies, the pandemic was about to accelerate the world by many years. What do I mean? The example in auto retail was everybody knew they had to learn how to sell a car online. They've said, yeah, sometime in the next 5-10 years, I'll do that. CarMax, the largest retailer in the United States, shut down in California as a retailer in many stores